Today's agenda on the first session. So we're going to run quickly through that. There's the NetNada research reports, and then we're going to go from that to the governance and the governance questions straight away. Before the Q&A or after Q&A, I actually have 3 best tips that kind of consolidate my best tips for governance. So stick around to hear those. The report we've ran early this year. We've ran a bunch of interviews, and also the readiness assessment that you had access on session 1. We gave that with the help of Maka to 50+ companies and professionals, and we compiled all those research and all those numbers into a report. We're now using segments of that report to kind of enhance the value of the sessions on the different pillars of ASSP. One of the results is this thing. There is a scale from 1 to 6 when it comes to how ready they are to report, and it's like the place where on average everyone is falling. So that's really, really important. But also what's really important from the report is actually the quotes that we got from the people that we interviewed. The reason that they are relevant because inside those quotes, you're actually capturing a lot of maybe sometimes emotional context or context awareness of what's happening within these companies. And even though it's not hard data, it is very good to kind of capture what others are feeling and try to adapt that to your own reality. The second thing as well is by looking at the transcripts of the conversations and what had been said is to kind of identify areas of concerns that have been mapped out across all the participants. Of course, we have technical knowledge, which is understanding of ASSP, understanding the nuances, understanding carbon accountancy as a 100% kind of barrier or concern. But then we have company engagement, and this company engagement is very linked to the governance that we're discussing today. And one of the metrics within that company engagements is actually that 100% of professionals that engaged in the research identified board engagement as a critical success factor. So they know that it's needed, they know that governance is important, and as part of that governance, board engagement is one of the missing pieces, and they've all expressed awareness that they were either struggling or that they were aware that there is a critical success factor if doing that well.
Alfonso, just jumping in there. Why do you think it's so unanimous? Because people are struggling to get boards engaged, or why do you find that?
The nuance behind the 100% and why it's such a very common result is one from the legislation, like that board is actually mentioned in there as well as like the higher level of like governance. So they capture the information while reading the legislation and they identify that. The second is sometimes sustainability professionals within large organizations, they're far away from the board and the chance that they have to communicate, so they can already foresee the hurdles of trying to get in front of these boards for education, behavior change, title changes, remunerations, and so forth. So yeah, really good question, Maka. Anyone questions on that, please do let me know. So that's kind of the quick summary. Of course, always I'll send the resource afterwards. Feel free to read through that. But it was a fantastic effort, and we are looking to kind of redo the same research later in the year or early next year. Quick recap on mandatory climate reporting. This is similar to the first session, but one really key thing to understand, and this is called climate-related risk and opportunities, and is linked to financial performance, which is like the bold here. So as you go through this exercise, always think about how is this linking to the financial health of the organization that I'm assessing. Okay, that's one. The second thing is, in terms of compliance, the people who are going to be reading this report are your primary users. Primary users is a technical term in the legislation. Always be aware of who's actually going to need to go to this information. Might be a bank, might be an investor, might be private equity, might be other stakeholders. So whatever language or whatever angle you are shaping up to distill a storyline or a key piece of information, make sure you think about who that might be, or all the users that might be reading through that. The more they can impact the financial health of your company, the more relevant they should kind of show up in your report. So yeah, just be aware of that. And finally, these things that can impact your organizations have different time scales, and we'll be looking at that through the short term, the medium term, and the long term. And you're expected, especially as we go into climate scenarios in later sessions, to kind of look at the different time ranges of these impacts. As I said, always try to keep the standard close to you, pinned in your browser in a folder, and Control F, read through that once you have questions, send it to me and ask for clarifications, whatever it might be. But the more familiar you are with the standard, the easier this becomes. And everything I say here is kind of paraphrasing part of the standard to help you kind of come to terms of what it is. And I always try to kind of refer or link to the actual words that have been written. To this, like I said, for whom, the primary users, for how long, that short, medium, and long term, and of course the scope of the analysis, looking in that like physical risk, transition risks, and of course the transition plan of those impacts. Who's required to report? Everyone should have this screenshotted and saved in your computer. But if you're in this space, always being aware of if you are dealing with a group 1, group 2, and group 3 company. And finally, that what matters is the kind of the last day of that reporting period. So if your company goes through an acquisition or a demerging during like the year that precedes your reporting deadline, you might shift those groups. So from a financial perspective, if you're planning strategy for the next quarter, year, and you're looking to finalize an acquisition, also, have your, people involved in that strategy communicate with you, so you make sure that you understand if the company is going to be changing groups and how that can impact what you have to report. Finally, remember the submission date is that kind of September 16th. If you're reporting on that financial year. So you have that gap between end of financial year to the submission date. Just to reiterate, architecture of the standard, that is not just about carbon accounting. There's governance, strategy, risk management, and metrics, and we'll be covering all of those. But also, this is a very good snapshot to put in a board pack as you communicate with your stakeholders, that the task at hand is bigger than what they normally would think about that sustainability entails. And of course, the big elephant in the room, assurance. Also have this screenshotted, have this at hand, that there is kind of a scaled rollout of assurance, but in the first year, governance has a limited assurance, so strategy, risk, and opportunities. And just because things like climate scenario analysis don't have assurance does not mean that they don't have to be disclosed. All right, so that's just kind of different. Just because you have a white box here does not mean you don't have to disclose these things in your report and be non-compliant. So super kind of important to have this at hand, also to translate the importance of these tasks with the people involved. That is not just about going through the process, but documented the process in a way that you can get assurance on that. If you have any questions on the rollout and how to collaborate with your auditor, please do let me know, and yeah, ask me any questions about that. My hot tip in here is the earlier you engage your auditor in this process, or you aim to do a dry run, the easier it is, because you want to make sure that the processes that you're setting up, the systems and so forth, are relevant to what your auditor is going to be seeing. And finally, don't assume that your auditor knows exactly what they need. They'll probably say, send me what you have and I'll assess it. There are pros at doing that. They're auditors. So you might have to kind of take the first leap of faith, try to prepare what you have, collaborate with a consultant, collaborate with NetNada, and then send it over to the auditor for the first pass and analysis. Any
Alfonso,
questions on that? Yeah,
I'm gonna jump in that. I have actually 2 questions on what you just said. In terms of documentation, I mean, metrics and targets is easy. You can show the calculations, you can show the final numbers. But as you mentioned, there's more than just metrics and targets. So what type of documentations are auditors expecting to see?
Yeah, so that's a very good question. A good example is meeting minutes or agendas. So as I'll deep dive into, like, what does it mean to like educate a board or educate people. If you're going to do that education through a workshop, through a session, having evidence of who attended and what was covered, as an example. If you want to make a decision on, if you're going to make a decision of, okay, we're going to select this risk or this opportunity, documenting the like train of thought and who was involved and how you come up with that, like that methodology is what needs to be reviewed. So think about, instead of just looking at the final decision as the outcome, what you kind of publish in the report and normally you see in the glossy PDFs, think about all the work and process that went behind that. Saying that, okay, we train our board on climate related matters is one thing on the report. Behind that needs to be a document that says every quarter we go through this agenda and it's prepared by sustainability manager and the head of risk in partnership with an external consultant to train and upskill the board. That's kind of an example.
So it doesn't have like a it can have different formats depending on the business.
Correct.
Basically.
Could be, Excel spreadsheets, could be a document that's signed, could be a policy, and so forth. David, you have a question, which is what type of auditors are we talking about? Financial or compliance, like quality environments? Yeah, more like the financial type. So it could be like, your BDO, your EYs that will, normally also do financial accounts, will now expand into doing climate related auditing. This is not your environmental auditors that do like soil contamination or water quality. This is like the financial related, because this is a financial related disclosure that goes hand in hand with your financial statements. So like I said, what's this all about? This is about covering the governance, the strategy, the risk management, the metrics and targets. And that key components is that reporting entity, materiality, which we'll touch on a second, the comparison or the comparing of things during a period of time and things during a period of change, and the timing of that reporting. Even though this is about governance, I'm just highlighting the climate scenario analysis because it is one of the most challenging things to be tackled, or where people like spend most of their time. It's not overcomplicated once you kind of have someone supporting you or you grasp the concept, but it's something that people say, oh, climate scenario analysis is going to be very expensive or very hard. And I just want to make sure that like you kind of can foresee that. And this statement here, also feel free to copy and screenshot. Now, this is about a new rule. If you want to put it like in normal terms, all of this reporting is just about a new rule that says companies need to share information about how climate change affects their business. In short, that last bit, how climate change affects their business, is the whole core and the whole purpose of this new legislation. As investors, as shareholders and stakeholders, we want to understand if climate change, we don't care if it's going up, down, into the middle, doesn't matter. It's just whatever the different scenarios are, how does that impact the business, and will this business be viable moving into the future while we have sea level rise, consumer behavior changes, increased temperatures, and so forth. That's what they care about. And that you're making good decisions about predicting those things that's going to still keep a company making money.
And I guess that's where the financial terms comes in, right? Like, how is it affecting the business in a financial way? How are you calculating that and having those numbers based on?
Exactly. And which makes for, some hard conversations when you're trying to, quantify in dollars the impact of things like, a change in temperature into your business, which becomes hard, very hard, very quickly. What is governance in climate reporting? All right, we're going to the core of the presentation. The core idea is good leadership. A good leader looks at different variables in an organization, in their market, competitors, rising costs, changing technologies, and now as a good leader, they also have to look at climate change. That's the core thing. So if you approach someone as like, okay, you also need to tackle climate, the angle might be you just need to do a better or a good leader, and a good leader looks at everything that it can impact, that is material to their business. We want to know, by we, I mean like the public, the primary users, on how they're watching over things, managing them, and making sure they're being handled properly. The same thing that a good leader wants to have good HR, good investigation, good hiring policies, and good marketing. The same thing for like climate change risk and opportunities. One point here, and one of the quote from the reports is that this might be the first time some of the sustainability managers are going into a boardroom. It can be nerve-wracking, can be intimidating, or can be exciting. And there's this kind of assumption that like sustainability managers don't have the board speak and all the naming conventions and how to actually do that process. It can be quite simple. Doesn't matter if you have 15, 20 minutes. The clearer the language is, and the more down to earth it is, the easier the communication will be. And I'll touch on like a mindset change when it comes to speaking with boards at the end of the presentation. But yeah, just being aware that this might be your first time or your colleague's first time speaking to a board across these topics. Here we offer an example of what would be large organizations dealing with a governance structure related to climate reporting. It doesn't apply the same for everyone, and it doesn't mean that you have to have exactly this structure. You might never had a risk committee, or you might not have ESG committee, but looking at certain elements in here will help you put processes and practices in place to have a robust governance structure when it comes to climate. It plays a crucial role because if everything works together, you can keep track of what's changing. The easiest or the lowest hanging fruit is to actually tackle this ESG committee, which is a place that some of our clients and people in our network is the first step, which might be someone who's not responsible for ESG, bringing other parties together every quarter to discuss the progress they're doing in terms of disclosures, or even if they don't have to disclose, how they're doing overall in the initiatives that they've set. Also remember, normally they're called ESG committees, so which means they're covering more than just climate. They might be looking at how much time a company is volunteering or the policies to volunteering and so forth. So be aware of like the burden of tackling all of that plus the climate related financial disclosures. Also in the key components, board and committee oversights, what are the roles, how they're defined, are they written down, do they have sign off, roles and responsibilities, how often they're reviewed and by whom, all of these things, like I said, documentation, like Maka brought up, just be aware of writing these things down. And finally, there's different levels of things that need to be upskilled. I'm putting a red square here that while a sustainability manager already has some formal education on climate, right? If they came from like a formal background or they doing their courses, etc., the board might not have it. So focusing on that education to the board might be where you have more bang for buck. Just 1 second. All right, just checking timing. Perfect. Any questions on that? Any questions on this diagram?
I do have questions.
Yes.
Lots of questions today. On the one side, how do companies decide how often these climate issues get onto their board agenda? I guess it depends on the business, but what have you been seeing? And also, when you talk about upskilling needed, which type of upskilling or what does it mean?
Awesome. So how often? Like I said, you can cut this whatever you want, but we're seeing that if you're gonna, be preparing for your first disclosure, if you're gonna have a board meeting happening twice a year or every quarter, try to have a point there in the agenda where the sustainability manager or the SG committee presents to the board what has been changed or tries to get 1 or 2 action points out of that, right? It might only be 10 minutes where everyone in here is doing the work and you just have 10 minutes to present and kind of share what's happening. The frequency of meetings on SG committee could be monthly as an example, could be bi-weekly if you're trying to do a sprint for finalizing your carbon inventory or trying to do 2 workshops to do your materiality assessment, whatever it might be. When it comes down to here, the operational level, you might just have a reporting function or a new KPI in terms of projects that you're doing. That upskill, like I said, could be a formal workshop, could be a presentation that's shared, could be an online course that is done. It really depends on how that board or those committees or executive management is used to learning. It can also be attending a 2-day in-person paid session to upskill everyone at the same time across the company. Different formats, but you just need to make sure that you're selecting one that is right for you. And it brings me like, why does it matter, right? Like I said in the past, strong governance, when done right, is not just for compliance. It's about having this business to thrive and do well. And if you now run over the next 10 years without doing these exercises, you might be caught off guard and kind of not seeing new risks creeping up on your business. You might do a bad investment, buying a property that is in like a flood prone area, not kind of seeing a customer behavior change, or not capture the use of new technology that's going to bring down the greenhouse gases of a product that you manufacture, and missing out on a competitive positioning for certain market segments. So it's all of this. It's not just about the burden of compliance. It's about actually setting up your business for success. Of course, there's an inherent risk if you don't comply that you have fine. In this case, personal liability as a board for a business not being compliant and not meeting their regulatory needs. The other good thing is that by having this credibility aligned with common disclosures, makes everything easier. We know that it's not informal, it's not just a thing being done one-off, is actually part of your business as usual, and makes it for more credibility in terms of who you are as a company dealing with climate-related matters. Now we have a couple examples, like I said, of course, from big organizations, and there's no one on the call kind of building at this level, but you can draw some elements from here in terms of how they are represented, but also what key elements are involved. And you might actually reach out to people in these companies to ask for feedback or ideas or conversations about how to deal with this structure. A good example here in the Optus side, you actually have a risk committee and an audit committee. They work kind of separate. Some companies might have like risk and audit together, or you might have risk and climate risk together under the same lens. Same things like your ESG working groups, in this case, are separated across different topics, right? You might have an ESG working group for modern slavery, ESG working group for like climate action. At a small organization, that ESG committee or working group might have a different kind of scope of what is material or what you have resources to tackle. Westpac, same thing. As you can see, it flows all the way to the board, but you have things like ESG and reputation committee. So they're really kind of associating like the external positioning of Westpac, and under that you have an ESG council. So the reason we put this here is just you are familiar with different names, so you kind of expect different ways that people are shaping up their structure to meet the same criteria of legislation, but it needs to be something that fits your business. So as a consultant, if you're going to go in, try to do this mapping for your client and understand what's already in place. Look at the names that they use and kind of suggest different ways of working. If you're doing this internally as a company, even as one person dealing with the whole of climate, think how you can go from just being an ESG lead or sustainability lead into setting up a committee or having more time with the risk committee or the board yourself to kind of tick those boxes of governance and ensure it's set in place. Again, really high level examples of large organizations, but hopefully you can draw inspiration from that, and also the initial diagram like here.
Alfonso, sorry, just there, have you seen examples? I know you said this is very high level, but have you seen examples of companies that have to report and that they don't have an ESG committee? So it's only sustainability. What are you seeing?
I think I don't remember the top of my head, but there was, because I've been actively looking through those, ASSB aligned reports, so like CSRD in Europe. There are some companies that fuse kind of, like I said, your risk committee. It's risk committee, even though it doesn't have the name sustainability, it's the only committee that exists, and they're the ones dealing also with climate related matters and bring like that. Some people skip the ESG committee and just go directly to educating like the line managers, and they're responsible for different parts of the business. A good example is they might skip the committee, and now the head of procurement has their own KPIs on changing contracts and how they are procuring things. Then you have HR who looks at like training and capabilities, and then you have technology that kind of look at new opportunities. So you kind of do that by skipping some of more like the formal committees, but they end up doing the same thing, and sometimes you might not have as much of the burden of having those regular catch-ups as a committee. But again, different shapes and sizes, especially when it comes to the size of the company and how you can create those structures. Great question, Maka. And again, anyone that wants to tag along from Maka's question, please do let me know. So what do you need to disclose? I'm going to start here at the top. We have things to consider. We have the board role in climate risks. You actually have to state what is the role of the board. You have to consider what are the climate risks as a business imperative, like as core, and they cannot be siloed as just an environmental concern. They need to be part of the business. And like I said, it impacts the operation, finance, and reputation. If you can see the reputation here, that's why we kind of saw this ESG and reputation committee in the Westpac area. And establishing clear oversight. Define who is accountable. And this accountability is really, really key, because if you don't state the name of the individual, think about how you've done your ISO for security in the past, or you actually have done ISO for like environmental management systems. You need to name a role that actually on top of these things and needs to be to that level. Could be a committee, it could be someone amongst the board members, it could be management in different areas of the business. So question one, who is in charge? These are a list of questions that if you get this presentation, you can answer them one by one. And after you answer all of them, you've completed your governance section of ASSP. Normally, you can do it by yourself to begin with your best assumptions, and then you review these things. So like I said, who's in charge? Companies need to name the specific board, committee, or person whose job is actually overseeing the whole thing. And you need to name these individuals. You need to understand how senior or how educated they are in the topic of climate, to kind of build some robustness into your selection. Remember, the legislation always has in mind the resources available for the company, which means if you can say that you don't have resources to go and hire the best person in climate-related disclosures to be head of your sustainability committee, that is okay. You just need to kind of name and showcase the progress over time on how you're going to upskill the current people. Job descriptions, not just naming. Like I said, all of this as a context doesn't go into your public disclosure, right? You might state who it is and kind of the role, but the job description kind of gets set in your records. But just being aware that you need to actually define these things and get sign off from HR and create these roles. So like I said, don't just name who's in charge. You need to explain the responsibilities as it was at any other role. And you're gonna be judged when it comes to assurance, how significant, right? If you're gonna be head of marketing and then you have one extra thing, which is head of marketing, and you also have to deal with sustainability, it won't cut it. It needs to be part of your core function and have give the sense of structure and business as usual, that this person has the resources, has the know-how, has the time and the skills to deal with climate change related matters. If you were to work as an investor and you look at this company and all you have is a part-time role dealing with this for a company with 500 employees, you probably say, I don't think they're actually going to be able to pull this off. And you also don't see any spend in external consultants. So that's kind of the conversation that you need to be having. Question number 3, do they have the skills? I kind of already touched on this. But if you're going to be naming someone, right, today, is there any evidence that they've done this in the past, that they're interested in this, or they have the skills and know-how to tackle this? If this person does not have the skills, maybe the board as a whole or the individual that has been named, it is okay. However, you need to really showcase and plan to address those skills gap. You might say today, our sustainability manager is coming from a marketing function into sustainability. They have dealt with, maybe product related carbon emissions and some greenwashing things, right? But we plan to put this person into the GG Protocol Academy. We're also going to pay them to do a training session with NetNada, and over the course of 2 quarters, they're going to do a mock disclosure with XYZ, right? just formalize how you're going to train these individuals. Same thing with the board. Out of the 6 people in the board, only 1 board member is also in another group 1 company that is dealing with climate-related matters. The goal is that every quarter we're going to train the other 5 board members on what the legislation actually entails and cover one of the pillars every session. Right? Those are the skills that we want to see and provide the training or bring in those external advisors to educate leadership. Really good position for consultants to kind of deliver value, but also for companies to kind of offload some of the burden of dealing with all the upskilling if they're trying to find time themselves to upskill. Question 4, and it comes to what question that kind of Mac asked at the beginning. How are you staying in the loop? How often, and how are you documenting this? Finally, remember, this is all linked to the paragraph. So if you want to read the actual words of legislation that translates into this, you can take this part of the slide and then Control F and go look for that information. We want to know, the general public, how these leaders make sure they have the right knowledge and abilities to understand and guide the company. Especially here, the guiding the company is not just understanding, I have time to learn, but I also have time to deploy change within the company to make these things happen. Key things to consider: how frequently are these things discussed? If it's maybe once a year, might be enough if you know that 5 of the 6 of the board members are sitting on another board that's doing the same thing and they're getting trained there, as an example, right? But most often you have to show more cadence. What kind of information is provided? A good example is they're gonna be reviewing the risk register of climate-related risks every session. They might be involved in the sign-off of the scenario analysis, or maybe one of the 6 board members actually gonna join the workshop of doing the scenario analysis, with an external consultant to do that. Finally, how or who provides this information? Is information being shared monthly as part of the scope of work with the consultant, or is the internal team, like the ESG committee, every time they gather, they provide an agenda and a board pack and they send that over? All those things is what needs to be documented and written down as evidence for your audit. Might be kind of sounding like overwhelming. You maybe haven't done this for any kind of information that you're familiar with. It's never too late to get started. Like I said, we help a lot with policies and documentation and templates. If you need any help on writing these things up, feel free to kind of get in touch, and we're happy to kind of assist you.
And we have a question in the chat from Anne. She's asking, for small companies with no previous governance or structure, now using a consultant to help them get organized and their permanent roles and responsibilities is work in progress. How do you disclose that? How do you explain it's in progress and it's not completed?
If you're doing this, so again, and if you're a small company and you're doing this to kind of try to align, even if you have to disclose, I would just recommend exactly what you were stating there, the strategy and for how long this engagement is going to be. But a good thing that I also recommend is disclose that where you are. Like today might be a maturity rate of 1, right? In this journey, you're hoping to get to maturity rate of 3 after you finish this engagement. And also at the end of that, we're going to implement a system that helps us, keep on check of progressing our policy writing from, having 5 to the 20 that we need to meet compliance, right? Just as long as you pinpoint these different stages and you show context and know-how and awareness that you are not at the end of the ride, it will be enough. I just want to emphasize that the relationship between the consultant and the companies are important, but think about the long-lasting relationship if you're going to be embedding a system or a policy that forces you to revisit these things over time. Happy to end to kind of deep dive into that discussion later as well. Another question from Sonia. Do you foresee the sustainability managers, whoever's taking charge, need to get CPD to prove they keep up to date with legislation and changes in the sustainability space? No, I don't think you need to pay for CPD points to showcase or formalize the evidence of your training, especially not at this stage, maybe later down the track. But there is so many ways to showcase evidence of that learning, especially in the doing. It's like if you have done your scenario analysis and you showcase that you're like improving over time, showcase that you're learning and adapting. The formal pathways, just because you are doing what I would call, like, let's say, private education pathways, does not make it like less available or less valuable compared to doing like a formal training. Might be a micro credential from a university as an example. They all play a role. What it's taking into context for the auditability and the assurance is how many resources this company has available to do that training. They're not expecting you to spend a quarter of the wage of the person taking charge in training if that's not possible. So it really depends on the situation. I just think the more transparent that training is, the better. So if you're doing a course where there is no curriculum available to showcase evidence of what you learn, then maybe don't do it. But if that's a curriculum that you can attach and they sign off and there's an accreditation or the certificate, that would be enough. I really recommend as well in-person events that are free from these big bodies. Not the conferences, but like the trainings or the webinars. Really, really valuable places to kind of like learn and distill that information.
And then we have another great question from Ruti saying, for a Group 1 company looking at climate disclosures for the first time, is it correct that we only need to disclose on a climate transition plan if we already have one in place, or we don't need to create one for the purpose of reporting, at least for year one?
I'll have to check. Your climate transition plan is not audited, but it still means you have to disclose the effort. It might be, again, don't quote me on this and I'll research, but a good example could be after assessing the available resources to complete this, your company did not find any material topics that force you to go and complete a robust transition plan for first year disclosure, right? That might be your statement. However, you have to think about your organization against their peers, and from an external positioning, looking into that Group 1 company and saying, well, they didn't spend the effort to look at your transition plan. Like, how serious are they about tackling this, right? That's the perception, and that's like the conversation you have to kind of navigate. But yes, you could approach something in that way. Or, we are doing our, climate scenario analysis, and we've done it in this way. In the next 6 months from that, we're going to perform our transition plan based on XYZ.
So you don't have to do it, but it's not mandatory, but you have to explicit why you're not doing it, basically, right?
Correct. Again, don't quote me on that. I'll triple check, but there is the robustness. So you might do a transition plan by like comparison. You might do a transition plans by like, using like the negative instead of the positive to kind of construct what that look like without doing the whole effort. So there's a last question from Sonny before we move on, which is about accountability job function for sustainability. Does it need to be one executive, or it could be a shared accountability? It could be shared accountability if they're part of like a committee that has been formed, right? So you can say across these 4 people, they're going to be responsible for XYZ, as long they're part of like a formal committee that has been set up. If it's going to be individuals, it needs to be, okay, the CFO is going to be responsible for this, and they're going to meet with the CEO on this cadence, and they're going to be responsible for that, and the CMO is going to be responsible for X. Unless you kind of bring them all together into a formal committee, and you give responsibilities for the committee, and you state the skills and the know-how and the knowledge of the people involved in that committee. I hope that answers your question in terms of like formalizing those roles and responsibilities when it comes to like having shared responsibilities of certain things. All right, into question 5, 15 minutes to go. Climate change and big decisions. This is more like now the content of what's being talked about, right? We need to know if these leaders are considering climate change when it comes to the planning and the strategy, making decisions when it comes to like measure deals and investments, setting up and dealing with the risk management, and of course, thinking about the trade-offs of doing one thing versus the other, which is kind of comes into your strategy in climate scenarios. The biggest kind of takeaways is point number 3 here, which is I want to see, as the primary reader, if climate risks have been integrated into the overall company risk management framework and the overall governance of this company. I want to see if they're taking this seriously and that they're thinking about this when it comes to big decisions, like, for example, deploying the capital that I've gave as a bank to this organization to do an investment, and now they're going to invest in a warehouse that actually sits in a flood-prone area with a massive risk. That's what I want to see, that they're going to be doing some analysis before they deploy that money. Setting and watching goals. This comes into kind of metrics and targets, and the linking to that is that ambition level of what they're going to set, what information that they're using to kind of set those targets, how they're comparing to other peers, what sources of information do they have to then kind of deploy this knowledge. And the biggest thing is the last point, and what's here in bold, the impact on how the top level executives and managers get paid, right? I actually didn't get an example here, and I'll find one and link it to you. The remuneration package, which tends to be very complex for large organizations when it comes to shares, cliffs, equity, paybacks, etc. Thinking that now on top of that, you're gonna have a climate-related target to hit a certain monetary package for this person. And this is a very, very intimate conversation to have, to say, okay, if you want to hit also a 2% bonus, you need to make sure that the company hits your 20% renewable energy target, right? It is now it goes from up in the air to how people get paid, and suddenly it changes the conversation and how involved they should be, right? How serious those targets are and how they relate to remuneration varies between company and how ambitious they are, but just understand that you need to show there's a significant link to that, right? I just lost my mouse for a second. All right, so this is, we're going into that executive management. The titles here of these roles don't have to be this, and just because you hire a chief sustainability officer doesn't mean you have everything solved. And you might never have a chief compliance officer if you're a group 2, group 3 company, but kind of have an idea of how maybe different people already in your company have these different roles mapped out, and that this whole pressure sits very within finance, who are now being flooded with data and reporting requests from sustainability managers on top of their day-to-day. We have a very good success story. Market today just walked in and said, we've completed a carbon inventory in 24 hours for a client because of the system of NetNada, because of data availability that this client had to begin with to be able to run that inventory. Just being aware that not every company will have that in place, and understanding the extra burden they're going to be placing on your peers if you don't bring context to that and why it's important and how they're involved, you might face a lot of difficulties and backlash on trying to get your job done.
Exactly. Just to add on that, yeah, I think it's important to mention that in regards to data, it needs collaboration from lots of teams: procurement, sustainability, finance. But it's important to highlight that finance has probably, in many cases, 80% of the data, it's under finance. So it's important to have them on board from the beginning.
Yeah, exactly. Especially when it comes to that metrics and targets. In the governance, it differs, and when it comes to climate scenario analysis, you need everyone involved, right? But just be aware of those things. Now, you're not, anyone here in the call is not a board member. I'm a board member in 2 different companies, and it's a different kind of situation. And if you are, you know there's a different thing between being on a board and then the day-to-day of having a role and being a manager. And sometimes things to consider is, if I hire a CSO, will my problems be solved? Not really. You don't need a CSO. You might need that same role distributed across different people, like we've discussed, and you might not even have that title, but you just need to be able to name someone responsible to get this done. The second thing is, if you think about that like diagram we had in the past, hiring someone or giving someone the responsibility of sustainability or climate reporting on the side, right? It's the same thing as not doing anything. We need to see those reporting lines flowing through the whole company, or that this person sits within the necessary committees to get their job done. So if you're going to hire a sustainability manager, it needs to be in the ESG committee. It might need to be also overseeing like a working group, and also being, in every 2 sessions with the risk committee, right? Or needs to have a direct access to the CFO to get the job done. So there's all these things we want to have, and also that management reporting, it's happening on a regular cadence, not as only critical things come about. So just kind of this is more like now on the operations side of getting things down, but just describe how top leaders keep an eye on this person as well, like who's overseeing, who's doing the performance reviews, and who's managing progress over time. Question 8, and I think it's like the last one, if I'm not wrong, management tools and integrations. Again, you can look into the paragraph. This is where having a system, right? And the system could be spreadsheet, it could be NetNada, it could be whatever it is, that when you're building these policies, this governance, by showcasing evidence that you are building like a long-term IP and robust system in collaboration with whoever it might be, right? It could be a consultant collaborating with the system. You show that it's being integrated as part of something that is being reviewed. A very good example is ISO, right? ISO sets you up for certification, and then you have to review it, every year for the next 3 years, and then every 3 years. That's what we want to see in terms of like who's reviewing the remuneration packages, the policies, the risks, your materiality assessments, and so forth. And one last thing is, like, if you don't have the system, sometimes it's hard to see how climate-related data is being used for the decision making. Well, if you have a system, whatever that might be, and you showcase that you have access to emission factors, or you have access to be able to, at your request, call for like new climate-related data to run a new analysis, or which tools are available or how much they cost to do that, kind of helps set up the intent or showcase that this company is ready to, when they need to, call upon that data and those tools and integrations to get the job done. The key term here is this control and procedures. If you don't have those controls written or the policies written, it is hard to see how it's actually being integrated in your day-to-day. And at the end of the day, that's what we want to see. Any questions? I know it's a lot of information. And after this, I'm going to give you my 3 hot tips. And I've been loving the chat and Maka's questions as well, which is great. Thank you, Ruchi. I know you had to jump off. If you don't have any questions, with 5 minutes to go, I'm just going to show you my hot tips and also some resources that you can use ahead of the next session. My top tips is, boards are your friends. Someone in a board is also normally in different boards, which means there are cross learnings that they have. Don't see boards as old people who don't care about climate and they just want to get the job done. Think about boards as someone who are keen to learn. That's why they join the board in multiple boards, and they're actually eager to kind of jump on these new opportunities and showcase their value, right? So see them as your friends, as someone who can also bring knowledge from someone in a different sector, a different size of company, and then distill that with you. Go seeking feedback and bouncing ideas, not just being dreaded by the task of trying to force information to these boards. Secondly, document everything. Document that you attend the sessions. Document that you've done the NetNada Academy. Document every time your committee meets with agendas. Use an AI note taker and put that into a file and folder. Do that because that will help you into the future. And then pay or formalize training. This is when it comes to governance. If you're going to be training in the NetNada Academy, save that. If you're going to pay for a 1-hour session, keep that invoice. Keep track of who you engage, because you want to bring all of that together, right? To be able to build your case or how governance is integrated. And finally, it's only here, but it was covered just before, bring the system in, whatever it might be, to keep track of who's going to review it, who's going to audit, who's going to sign off, and how often you have to do it to kind of showcase that evidence. And finally, tools. There's a readiness assessment from the last session. We have a workbook with all the legislation and all the paragraphs that you need to track. We have the reports. We can help you build a roadmap. And then we have the academy. And of course, we have the NetNada, engine itself as a software. But just be aware there's a lot of things that you can do to get going. On average, it takes 15 to 18 months to complete a whole disclosure, depending on the size of the company and complexity. But just get started from moving from these sessions into actually getting something done that you can report back to the board or executive managers as evidence of progress over time. That's kind of all that I have for today. There's a question: any more published reports from phase 1 that you would recommend reading? We're speaking with UC tomorrow, but we'll compile all the reports as we go through that, and we'll hopefully create a little database for everyone to access and be able to compare how different people disclose different things. So stay tuned for that.
And we're also going to send the recordings and the slides for everyone.
Correct. Thank you so much for everyone. Really, really appreciate it. Have a fantastic end of your week. Like I said, you have my phone number, my email signature, you have my email, and feel free to get in contact at any point. Fantastic to talk about governance, and have a fantastic day.